What if the biggest revelations aren't blasting across cable news at all, but sitting silently inside cold, verifiable financial records? Think about it. The real story about money, influence, and political power isn't hidden, it's documented, dated, and resting in the hands of top prosecutors right now. This is far bigger than the usual cycle of everyday political theater. What if the loudest headlines are actually the least important part of the story? What if the real pressure point isn't coming from cable panels or campaign speeches, but from silent rows of financial records documents stamped with dates, signatures, routing numbers, and approval chains that don't care about spin? Because when questions of money, influence, and political power collide, the truth often doesn't arrive as a rumor. It arrives as documentation. It sits in transaction logs, internal reviews, and subpoenaed files, waiting for prosecutors to assemble the larger picture. And if that picture is still expanding in court instead of collapsing, under scrutiny, then this is no routine political spectacle. This is the kind of slow-building financial confrontation that can outlast news cycles and reshape the entire narrative. What is emerging is not a simple controversy with one explosive moment and one clean explanation. It looks more like a sprawling network of financial decisions, institutional warnings, delayed disclosures, and legal pressure points that may connect in ways the public is only beginning to grasp. Every large transfer leaves a trail. Every approved loan has a paper basis. Every discrepancy between what was claimed and what was recorded creates tension in the story, and that tension matters. Because unless the legal landscape changes dramatically, the possibility remains that tax records and supporting financial materials could be compelled into the hands of a New York grand jury, subject to the same legal expectations that apply to anyone else. That possibility alone tells you something important. The door was never slammed shut. And that is where the legal reality becomes impossible to ignore. The Supreme Court did not wipe away the scrutiny with one sweeping act. Instead, it sent the fight back through the lower courts, which is a very different signal. It meant the investigative path remained open. It meant prosecutors still had room to argue, request, challenge, and pursue. In cases involving complicated finances, continued forward motion is rarely meaningless. These matters do not keep surviving procedural attacks for no reason. When a case continues to breathe after repeated legal battles, investigators usually believe there is something substantial worth protecting and pursuing. Smoke alone does not keep a matter alive for this long. Persistence in these cases often suggests that the people closest to the evidence think the underlying fire may be real. To understand why that matters, you have to understand what serious financial investigations actually look like. Most people picture a few analysts leaning over spreadsheets, circling strange numbers, and hoping one of them looks suspicious enough to matter. That image is far too small. Modern financial probes are not about isolated arithmetic errors. They are about narrative reconstruction. Prosecutors are not just handed balances and totals. They are handed behavior. They receive a map of how capital moved, when it moved, why it moved, who signed off on it, what representations were made along the way, and whether those representations stayed consistent depending on who was asking. A bank record is not merely a list of amounts. In the hands of specialists, it becomes a chronology of choices. When a bank turns over material under subpoena, the significance goes far beyond account statements. Investigators may receive transfer routes, internal risk assessments, application materials, compliance notes, communications between senior staff, alerts triggered by unusual patterns, and long-term account histories that show not just one event but an entire operating style. That distinction is crucial. A single anomaly can be explained away as an oversight. A recurring pattern is harder to dismiss. When the same kinds of discrepancies appear again and again across years, especially in contexts involving taxes, loans, valuations, or reporting thresholds, they stop looking accidental. They begin to look systemic. This is where forensic accountants become especially dangerous to anyone trying to survive on selective storytelling. They do not look at money the way the public does. They look at cadence, contradiction, and repetition. They examine whether the cash flow described in tax materials aligns with the optimism presented in loan packages. They compare valuations used to impress lenders with valuations used to minimize taxes. They study the timing of transfers to see whether funds were moving in ways consistent with ordinary business needs or whether the patterns suggest deliberate structuring, concealment, or pressure management. Over time, those repeated movements form a behavioral fingerprint. That fingerprint can be far more damaging than a dramatic witness because it is built from the subject's own financial trail. One of the most powerful theories available to prosecutors in major bank-related cases is astonishingly simple. Did the story told to secure money match the reality reflected in the books? That gap between representation and reality is where many fraud cases live or die. If a borrower presents one portrait of wealth, stability, liquidity, or collateral strength in order to unlock favorable lending, but the internal numbers tell a much weaker or very different story, that inconsistency can become devastating. Jurors may disagree about politics, personality, or media narratives. They understand misrepresentation. They understand the concept of saying one thing to get money while knowing the facts tell another story. In that setting, financial cases stop being abstract. They become concrete. That is why the role of major lenders matters so much. Institutions such as Deutsche Bank reportedly turned over extensive records to New York investigators, and that matters not because the bank is famous, but because of what a lender at that level can see. Such records can include years of borrowing history, repayment concerns, internal deliberations over risk, supporting documents submitted by the client, and the institution's own private judgments about exposure. That is not a narrow window. That is a deep archive. If prosecutors possess that kind of material, they are not guessing from a distance. They are reading from inside the machinery. Deutsche Bank in particular has drawn outsized attention because of its long relationship with a client many other major institutions were reportedly reluctant to back. When other financial powerhouses became more cautious, Deutsche kept engaging. That kind of sustained relationship gives a bank unusual visibility into the borrower's world. It means repeated contact, repeated requests, repeated reviews, repeated debates behind closed doors. A bank in that position may see not only the polished pitch presented in public-facing documents, but also the internal strain behind it. Hesitations, escalations, exceptions, and concern about whether the risk was becoming too severe. If those internal debates are now in prosecutorial hands, the meaning is enormous. It means investigators may be able to compare what the public saw with what the bank privately feared. That becomes even more consequential when placed beside the findings from the New York civil fraud case, where the court concluded that asset values had been materially misstated. Those civil findings do not automatically resolve every criminal question, but they do establish an important reference point, if a court has already determined that valuations were manipulated in significant ways. Then prosecutors examining lending files are not starting from scratch. They are no longer asking whether exaggeration may have occurred in the abstract. They are asking how those misstatements functioned in real-world transactions, what loans they helped secure, what terms they influenced, what decisions they triggered, and who knew what at the time. The difference is critical. A civil ruling can become a foundation stone in a much larger structure. And once you start layering records on top of findings, the theory becomes easier to visualize. If property values were dramatically elevated when financing was sought and dramatically reduced when tax obligations were at issue, investigators will want to know whether that pattern was incidental or deliberate. They will compare the numbers in court-tested findings to the numbers sitting inside bank files. They will ask whether financial institutions were induced to act on claims that insiders knew were unreliable. If the answer points toward intentional inflation or concealment, then prosecutors do not need a flashy new storyline. They need only demonstrate consistency between documentary proof and legal findings already on the record. But the financial trail does not end with loans and asset values. Another major arena is compliance, specifically the internal systems banks use to flag behavior that may indicate money laundering, fraud, or other illicit conduct. Suspicious activity reports, commonly known as SARs, are uniquely important because of who creates them. They do not come from campaign opponents, aggrieved ex-employees, or television commentators. They come from the institution's own compliance professionals, the people tasked with protecting the bank from regulatory disaster. When those professionals decide something is serious enough to report, they are telling the government that the activity crossed an internal threshold of concern. That creates a striking tension if the same client is also receiving large-scale financing from the same institution. On the surface, the relationship may appear commercially productive. Loans issued, deals moving, signatures collected. Underneath, compliance personnel may be sounding alarms about patterns they consider troubling enough to memorialize for federal authorities. That split-screen reality is exactly the sort of thing investigators look for. It suggests a private level of concern that may be very different from the image presented publicly, and once prosecutors obtain both the outward transaction record and the inward compliance warnings, they can begin comparing appearance to apprehension. If those two stories clash sharply enough, that clash itself becomes evidence. Then there is the separate but equally combustible question of stock trading and public decision-making. Recent disclosures have drawn attention to roughly 170 trades involving financial sector companies, with a total value around $20 million, reportedly occurring during a period when major federal policy affecting those sectors was taking shape. Standing alone, trade volume does not prove misconduct. Context is what matters. If the officials or figures involved had influence over decisions affecting those industries, and if the public learned about the transactions only later through ethics filings, the delay becomes part of the problem. Disclosure. Rules exist to preserve transparency before power is exercised, not merely to document conflicts after the fact. That distinction matters because late disclosure can defeat the very purpose of the rule. It may create the appearance that the public was deprived of the chance to evaluate possible conflicts while policy choices were still being made, and if the investments were connected to the industries most directly affected by those same policy decisions, investigators may start asking more uncomfortable questions. Was there self-interest embedded in the process? Was non-public information used in a way that advantaged private wealth over public trust? Was the disclosure framework treated as a safeguard, or as a paperwork formality to be addressed after the benefit was already secured? Those are not minor ethics questions. In the right factual setting, they edge toward the language of corruption. Taken together, three major structures appear to be supporting the pressure on this matter. First, there is the long and unusually revealing relationship with a lender capable of documenting years of borrowing behavior, risk concern, and representations made in search of capital. Second, there are internal compliance systems, including SAR-related concerns, which may show that parts of the institution itself viewed the financial activity as troubling. Third, there are the delayed trading disclosures, which raise a different but related set of questions about whether private financial interests and public power were allowed to overlap in ways the law is designed to prevent. Each of these areas would be serious on its own. Combined, they create something far larger: the possibility of a coherent financial narrative stretching across institutions, years, and different forms of scrutiny. And that may be the most consequential point of all. The story here is no longer about a single bad document or a single embarrassing filing. It is about whether multiple streams of evidence reinforce one another, whether the loan files echo the civil findings, whether the compliance alarms support the prosecutor's suspicions, whether delayed disclosures reveal a broader pattern of treating legal guardrails as inconveniences rather than limits. When separate categories of evidence begin pointing in the same direction, the investigation changes character. It stops looking like a scattershot search for problems and starts looking like a disciplined effort to describe a system. If prosecutors and forensic teams continue following the records, the real question is not merely what has already surfaced. It is what remains buried in the next tranche of files, the next chain of emails, the next set of internal reviews. Will additional evidence sharpen the theory into something even more precise? Will more records become public and intensify the legal and political fallout? Or will the next phase of litigation determine whether this mass of financial evidence can survive the brutal testing ground of an actual courtroom fight? That is where the stakes now seem to reside. Because when investigators trace conduct over long periods of time, they are not looking for isolated mistakes. They are looking for recurring strategy. They want to know whether debt was being serviced through genuine financial strength or through constant refinancing that preserved an illusion of stability. They want to know whether executives inside the bank privately questioned the truthfulness of what they were being told. They want to know whether discrepancies were occasional, or whether they formed a durable method of doing business. If the answer points toward repetition, then what might once have been dismissed as noise starts to resemble design. And at that level, this ceases to be a fight over bookkeeping or a dispute about technical compliance. It becomes a deeper question about the relationship between enormous private wealth and public authority, about whether the same person or network could shape both finance and governance while shielding the mechanics from meaningful scrutiny. The ultimate outcome will depend on facts, law, and the discipline with which prosecutors connect one document to the next. But if those connections hold, this will not be remembered as just another investigation. It will be remembered as a moment when ledgers, filings, internal warnings, and delayed disclosures combine too. Test whether power can still be contained by proof.